Your portfolio companies have actually posted a 16% growth on the top line. Margins have expanded and profitability is very healthy as well. Whereas the index is flat on the top line, good margins and good profits, and obviously this is happening for the second or third time. I want to understand from you, what kind of commentary are you gathering, or what kind of numbers have you worked for your own portfolio for full year next year? What kind of growth on earnings are you seeing for FY22, or even if you could share FY23?
Well, I think, Ajay, this time it is going to be a very, very broad-based earnings growth recovery. As it is already visible, if you look at the entire market aggregate as well for third quarter, it is contributed by a number of sectors. This is unlike last 3, 4, 5 years, where the growth was contributed by only 1 or 2 or 3 sectors. So normally speaking, you had a 2, 3 top private sector banks, 3, 5, 6 consumer names, and then there are others from respective two companies from each sectors. But this time, if you look at the broader market as well, the entire recovery is significantly, very, very broad based. And that's true even for our portfolio companies. We have seen recovery across our portfolio names. As you rightly pointed out, for third quarter, the Nifty has reported a degrowth in revenue, but our portfolio companies have reported very strong 16% top line growth and 30% profit growth against a Nifty earnings growth of about 18 to 20%. Coming to next year, Ajay, I think our portfolio companies are really very well positioned. And let me give you the secret sauce of why such higher earnings growth versus the market. Is primarily because all of our portfolio companies are market leaders. And leaders always benefit both in downturn of the economy as well as upturn of the economy. And that's basically a reason why we believe that our portfolio companies are rightly positioned to continue to outperform the earnings growth of Nifty, or for that matter, BSE 500 index. So we think recovery is going to be extremely strong for both FY22 and then the further benefits for FY23.
Right. Rajesh, that's perhaps the reason why you've kept your portfolio pretty diversified and broad, because you want to capture that broad-based recovery. Talk to us about which are the kind of plays you have in your portfolio where you expect earnings growth to be very robust, or do you have equally distributed weights in the entire portfolio?
No, it is not equally distributed weights. It is depending upon the market cap. If it is a large cap, it is between 3 to 5%. If it is a small and mid cap, it is between 1.5 to 3% kind of weights. But coming specific to the companies, or rather sectors, let me talk about sectors. The one sector which we believe is going to report extremely strong numbers is the auto ancillaries. And this sector is going to get benefit of both global markets as well as local markets. And so we believe that auto ancillary companies are going to do extremely well over FY22 and FY23. And of course, we are holding a few prominent names in this sector. Same is true for, of course, the large sector, which is NBFCs and private sector banks primarily, where we believe that earnings growth is going to be also very, very robust. The credit quality is going to be under control. The requirement of provision will be lesser.
You also, observe that part of the good news that earnings is going to revive in a broader market is pretty well known as well. I want to understand from you, because you've seen previous cycles, when you say you're positive in 3 to 5 year basis, do you think market will get more fuel going forward as and when earnings keep on coming, or do you think market actually, it may also get into a narrow range because market has already moved ahead of the good news, which is earnings?
No, I think we have still a lot of steam left. I think, capital expenditure is yet to revive. And as and when that revives, I think there will be the biggest leg. If you ask me, the biggest pillar for the next earnings growth story is going to be the capex driven story. And I think there is still a lot of things yet to be probably priced in. If you look at last 10 years, Nifty returns or BSE 500 returns or mid cap returns or small cap returns, they are not like 25% compounded. So I don't think everything is priced in. We believe that as the interest rate remains low, the earnings growth story will continue to remain strong. And I think there is going to be positive surprise in store as we talk for next 2 years.
Let's shift focus on the portfolio and market for a moment and talk about what kind of chats are you having with HNI community across the country. Is there eagerness to invest more or top up their portfolios? How are you getting in new clients? Give us some feedback, because the mutual fund community continue to see a lot of outflows, and we are looking at surge of DIY investors all across several brokerages. How are firms such as yours observing on things on ground?
Well, I think if you ask me incrementally, there is a feeling by most ultra net worth individuals that market will correct at some point of time. And I think which is the right observation, because the market is never one way up, correct? It has its own volatility. So what we have done is that very recently we have launched a triple liquid PMS plan. And it is a switch option that you can transfer from liquid PMS plan to equity plan over next 3 months, 6 months, 9 months, 12 months kind of a features. So it means that at every market correction you have an option to transfer from liquid plan to the equity plan. And I think we are getting sense from HNIs that they really like such kind of option, because then because of automatic transfer over a next 6-12 months. And further, they can prepone. If market corrects it tomorrow by 20%, they can, prepone, they can select that option as well. So I think this plan is catching up. This is really what HNIs are looking for, because they would like to use correction as an opportunity. Having said that, I always believe that timing the market is more important than timing the market. And people went wrong in last 12 months and historically as well, trying to predict the market timing. I think so. Every individual preference is different. You bound to have differences in terms of perception. And I think for time being, this is what right now we are, observing from HNI investors.
Rajesh, any interesting new space which you are researching or reading closely right now, just for academic purposes?
I think three themes, which we remain extremely positive. If you ask me, one, auto ancillaries, which we talked about. The second, specialty chemical. I think story continues here. I believe over next 3, 4, 5 years, you will see many bigger specialty chemical companies, just like in the pharmaceutical sector. And third is, of course, the capital goods related stories. And these are the companies which have delivered, I think, 0% earnings CAGR in last 10 years. So when people ask me that is it priced in? Definitely not, because 0% earnings CAGR and 0% market cap CAGR last 10 years. I think story is just going to start from here on. So I think these are the three themes which we are positive on. And while numbers may take some time for capital goods companies, but I think one need to have a close eye on the order inflows. And I think there you are going to see a good picture from month of April onwards.
Right. All right, Rajesh, we'll let you go on that one. Thanks so much for your time.